Welcome to Session 10 of RSM's 2020 Tax Summit. Today's event is 2020 State and Local Tax Legislative Recap. Our presenters for today are David Brunori, Mark Siegel, and Mobal Jacobs. At this time, I'm pleased to turn our call to our first presenter, Mobal Jacobs.
All right, thank you so much, Allison, and thank you all for joining today. Happy Veterans Day to our servicemen and women and their support teams on this 102nd anniversary of Armistice Day. Two quick housekeeping items I would like to get out of the way. We had a Ask the Specialist session a couple hours ago, specifically for state and local tax. We had some technical difficulties. I had some technical difficulties. So if you were in that session and you left early, you still have some questions, please send them to us and we'll make sure to circle around to that. Also, we have a participant guide, which is essentially, it's a supplement to this webcast. It doesn't mirror the webcast. There's information in the guide that's not going to be discussed today. There's discussion today that won't be in the guide. So please grab a copy of that. There are links in it, some articles, and other recent developments you may be interested in. So today is our year-end SALT webcast. We usually do this a little earlier, a few months earlier in the year. We wanted to plan it during this year during Tax Summits Week. There are a remarkable number of events occurring simultaneously that make this, I think, well-timed. One, we have the state and federal U.S. elections. We're in the middle of a global pandemic. I wish we could say we're at the end, but we're squarely in the middle of it still. We're coming off one of the worst quarters for state tax collections ever in history. So we're going to speak a little bit about that today. As Allison said, I'm here with my colleague, David Brunori, who's a senior director with our Washington National Tax Practice, and Mark Siegel, who's a senior manager in our Atlanta office. Our agenda today, we're going to talk a little bit about the CARES Act, some of these legislative developments that occurred throughout the year, throughout the last 11 months. We're going to put the CARES Act in context of some of the things that businesses really need to be thinking about. Certainly now in 2020, and then also as they look forward to 2021. We'll talk briefly about Wayfair. And I know this is the fourth or fifth year in a row that we've spoken about Wayfair, and maybe even now it's more important than any of those prior years. And we'll talk about why that is. And then we'll look ahead to 2021 as well. Our learning objectives today list three major topics aligned to. Okay, so those aren't our learning objectives today, but we hope that you do learn a lot and find some of our discussion interesting. As many of our sessions, we want to get a polling question out of the way as soon as possible. So we're going to start with one right now. What is the current state and local fiscal climate? So this is an interesting question. If you ever attended a RSM SALT webcast, you know that we ask this question quite a lot. We phrase it differently. We give different answers to the question. But we're always interested in what the business community is thinking and how they feel about the climate, because David and I are going to talk about it. But we're on the inside in the accounting firm side, so we don't always get the business perspective. So answer A, state and local fiscal climate is a doom and gloom. The states are completely broke and need cash now. Answer B, many states are facing potential shortfalls, but revenues may be stabilizing. Answer C, most states have recovered from a rough fiscal year Q4. And I'm going to refer to Q4 as Q2. It's going to be calendar year Q2, but those are our April, May, June months. And then answer D, what pandemic? The state, individual, and corporate tax cuts are likely to occur in fiscal year 2022. So take a minute to think about these. I think the answer is often that, yes, it's a combination of these answers. There's no wrong answer, of course. I'm going to close the poll now, and then we'll briefly recap this one. Okay, 38% doom and gloom. I don't think that's necessarily a wrong answer. There are states which are annually in bad shape, need cash now. I'm looking at you, Illinois, Pennsylvania, New York. You're there. You always need money. And then maybe there are some examples of states that really aren't doing, surprisingly, really aren't doing that poorly. So we'll talk about that. Many states, 56%, many states are facing potential shortfalls, but revenues are stabilizing. I think that's very true. Coming off of that Q2, which we'll talk about, that sounds like the last few months, and we don't have the entire picture yet for Q3, but it sounds like There is some recovery occurring. What that recovery looks like, though, is going to be debatable. 4%. Most states have recovered from a rough fiscal year Q4. I agree with that most states have not recovered. And then I think I would also agree with the 1.2% that, or I should say the 98 or 98.8% that think tax cuts are likely. I don't think we're going to see a lot of tax cuts in 2022 in the fiscal year. So it's been an odd year for state and local taxes. What's different about this year is that we didn't get a lot of significant state and local tax legislation compared to prior years. And we'll talk a little bit about that today. Mark's going to talk about the CARES Act for us and some of the things that the states have done this year. I think it was a lighter session for a number of reasons. If we go back to that March, April timeframe, that's really when the pandemic started to pick up. I think a lot of states were and a lot of legislatures were thinking about social distancing. They didn't have the ability to govern from a socially distanced location. So they were interested in getting their budgets passed and going home, buying their toilet paper and things like that. So it's a little different from prior years. What that means, though, is that states are still catching up from the federal legislation that was passed. And then they're also going to be catching up for these budget shortfalls that Dave and I are going to talk about here briefly. Q2, I want to read some statistics to you because I'm a data person. Overall, Q2, it looks like state and local tax collection revenue was down 29% over Q2 2019. So that's a significant amount. That was 17% in sales tax. Now, individual and corporate taxes were also down quite a bit. I'm not going to read those numbers because I don't want to bias anybody's thinking. The numbers were large, but a lot of that was due to deferrals for estimated payments and returns in the Q3. It doesn't change the fact, though, that there was lost revenue in Q2. People lost their jobs, so there were fewer withholding taxes, and there was also less consumption. To the extent there was consumption for sales tax purposes, people were buying a lot of things that aren't subject to tax, like groceries and paper towels and things like that. So David and I, we read every policy article we can find. We delve into state budgets from time to time. Occasionally, I ask David to read the tea leaves. We see these numbers: $200 billion deficit over the next, or shortfall over the next 2 years, maybe a $600 billion shortfall. David, can you provide any clarity on this? Are we better than we were in July? Are we worse?
Well, thanks, Mo, and thank you all for joining us. It's an honor to be here with Mo and Mark this afternoon. As the slides indicate, and I think we have some more information in our guidebook, the initial budget projections were dire, right? $600 billion. I mean, it was like Thelma and Louise going off the cliff. It was pretty devastating. And while most states are facing deficits still in the coming fiscal year, there's been some pretty good news of late, right? The GDP numbers that came out were really good, astonishingly good. We've recovered about half the jobs we've lost in that time period over the summer. The stock market is booming again, I think in part because of an anticipated vaccine. And if things continue, it's still bleak, but it looks like things are improving. That being said, the virus is still with us, of course, and it looks like it's spiking and getting worse in a lot of places. And if we face another round of shutdowns and significant shutdowns, I think it's going to have a devastating effect both on the economy and state budget. But I know one thing. Despite all of these problems, several states have enacted or proposed budgets in the last couple of weeks. Virginia this weekend, Vermont, Massachusetts, Idaho, Connecticut, all without new taxes or tax increases. Connecticut is actually proposing to delay tax cuts, so that's effectively a tax increase, I guess. But At least in these states, and these are pretty blue states except for Idaho. So you would think they might be more inclined to raise taxes. So things may not be as horrible as we thought, but most observers still think most states are going to have to find more revenue.
Thanks, David. And I think you mentioned something interesting, and that is we got some good news started to trickle in about Q3 tax collections. But at the same time, virus cases have just skyrocketed even over the last 2 weeks. I read that Maryland was going to reduce, or they were going to roll back some of their restaurant provisions, their full capacity provisions. So if it stays on this track, we're looking at more shutdowns, which means more layoffs, which means possibly more budget shortfalls. It's just a domino effect. And so we're not really sure what's going to happen in that case. We do know that most states have to balance their budget. Constitutionally or statutorily, they're going to have to figure that out. And every single state is in session in 2021. When we look at their options, at least from a tax revenue raising options, and of course some states have other options like cutting spending, which is hardly ever something we see really on the state level in large quantities. But we see the individual income tax overall for state tax collections. That's about 37% of state taxes. Sales and use tax is about 33%. Corporate taxes, not listed here on this slide, but it's only about 4%. Property taxes certainly very much on the local level, not as much on the state level. So just looking at individual income taxes, sales and use taxes, those look like really good targets because the tax base itself is so large, David. Well, I mean, it's 70%, I think, of total state tax collections. Are these the options that states are left with right now?
Well, you're absolutely right in terms of the size of the income tax and the sales tax. I think most state legislatures are going to be wary of increasing income taxes, personal income taxes going forward. One, I think they're very conscious about not enacting tax policies that may deter a recovery. So there's certainly a bias in most legislatures that income taxes are more harmful to the economy than, say, consumption taxes. And I think that if you're going to see tax increases from these two taxes, you're going to see it more on the sales tax side. And I think you're going to see some states look to expand the sales tax base to include perhaps digital goods in states that don't currently do it. About half or so currently do it, but the other half will be looking at it. Some states will look to maybe expand the sales tax base to include more services. There'll be pushback certainly on tax increases, right? Because when you tax something, you get less of it. Certainly retailers are not going to want higher sales tax rates, considering what has happened to consumption and retail sales over the last year. So I think there's going to be some incremental moves on some of these taxes. I don't think you're going to see a lot on the income tax. I know we may talk later on a little bit about millionaire taxes and things like that. So there may be a couple of efforts to go after really wealthy people. We've seen it in New Jersey and California and proposals in some other states, but I think that's going to be pretty rare.
Yeah, David, thinking about individual income taxes and sales and use taxes, most states, looking at the past 5 years, very, very few states have actually increased their individual income tax. In terms of sales taxes, very, very few sales tax rate increases. They're generally politically very unpopular. So I think maybe base expansion is something we could see, and that's something I'm going to ask you about here in a minute. And I think your webcam might have froze, so we'll have Jody or Allison help you out with that. New taxes on the horizon. You mentioned it. There could be some surtaxes, some wealth taxes, exit taxes, and gross receipts taxes. And we're going to talk about some of these in the next slide. And I think that takes us to our first takeaway, which is get informed, get flexible, and be ready to act. We don't really know what's going to happen. We were worried in the summer because things were very, very bad. We knew that there are going to be shortfalls. Then we just started to get some Q3 data that looked like things might have been recovering. But now the virus is spiking again, so we may be back into that. There's going to be large shortfalls again. So we have to be prepared. And I think as a business, it's really hard because there's so much information coming in. You get all the news sources, CNBC and MSNBC. You have all this information coming in, and you don't really know what to do. So we're going to try to keep you informed as much as possible. But understanding that there will be changes, I think, is the takeaway. Now, this next slide is a somewhat scary slide. So I want to just preface that. I like data and I like examples, and that's what we're doing here. Some of these have occurred, and some of them are just conceptual, and we're going to use them for talking points. These are possible proposals. So let's talk about California. Here was one to raise income taxes on high incomes over $1 million, over $2 million, over $5 million, with a max rate, personal income tax rate in California of 16.8%. So that this was proposed. That's a huge rate. Also, this is another bill, 4.4% wealth tax, and this is an exit tax. So if you have a net worth in excess of $30 million, you move from California. California continues to impose a tax on you for 10 consecutive years. So we talk about these exit taxes and wealth taxes. Sometimes we talk about conceptually. Well, here's an actual proposal. Maine considered a 3% surcharge that actually, I think it was voter approved a few years ago, but never implemented. New Jersey recently lowered their current millionaire's tax from it was a 5 million threshold. Now it's 1 million threshold. They also made permanent, or I think they extended the 2.5% corporate business tax surcharge. Seattle adopted a payroll expense tax. This year, Oregon enacted their gross receipts tax became effective. So these are very real things occurring. And David, if I have you back, I would love to get your comments on what you think about these types of proposals that we could see.
Well, I think I'm back. So I think these are rare. I think they're scary, certainly. They're rare. I think the millionaires' taxes are going to be confined to a couple of states. I think there's a lot of pushback by the business community, rightfully so, against gross receipt taxes. And again, I think there's a wariness about taxing business entities in the middle of a recession. I think that there's a lot of hesitation to do that because they think it's going to hurt investment and it's going to hurt jobs. The California tax, the wealth tax index, I think is crazy tax policy. Personally, I also think it's probably unconstitutional. I think that is also rare, although there is a proposal in New York, and I don't know where it is, but there was a proposal in New York to do a mark-to-market wealth tax, which is also equally as crazy for a lot of reasons. So you're going to see some of that. I think they're going to be pretty confined, though. I don't think you're going to see it across the board in most states. But certainly, if you're doing business in a state that's proposing a gross receipt tax, and I think there'll be some proposals, the business community's got to be aware of that, and be on top of it. I mean, talk about being trying to be on top of the game. That is one place I would be. And the other thing you may see along these lines is you may see more pass-through entity level taxes, and not just because of the recent news coming out of the IRS, but because it's a way to raise money, like the Illinois replacement tax, for instance. Certainly some states are thinking about that. But and then finally, by the way, which may affect some of you in the audience, certainly some of your clients, some states are thinking about reinstituting their estate tax, right? Most states got rid of their estate tax over the last 15 years or so. And I think only 14 or 15 states still have it. Some states are thinking about going back and reimposing the tax. So there's possibility. There's the possibility of higher taxes in some of those areas. I am skeptical, and the main reason I'm skeptical, and I'll leave it at this, is that none of the, in the recent election, none of the state legislatures changed hands. And you know, whatever was happening before will be happening again. I don't think there's any, the election at the state level is providing any mandate to do radical change across the country.
Yeah, that's interesting. I appreciate your skepticism, but I think at the same time, if we're looking at closer to that 600 billion shortfall, some of these proposals are going to get more interesting and maybe more aggressive. So I want everybody to be able to sleep at night. That this California proposal is not going to pass right now, but thinking that this is something that states are thinking about. Somebody had thought about that and put it into legislation. So this next slide is a graph. There's a lot of information on it. I'm going to explain it at a high level. You don't really need to be able to, you might need to blow it up a little bit, but you don't need to read the x-axis or anything like that. Two pieces of information. This is our sales tax collection graph. This shows about 12 years of data. The orange bars represent each quarter over quarter change in sales tax collections. On the left, you see that kind of U-shaped dip. That's essentially the Great Recession. And then interestingly, after the Great Recession, we had 41 straight quarters of growth in sales taxes. Now, the blue line is nominal collections. These aren't adjusted for inflation, but the blue line is the actual dollar amounts collected for every quarter. And you can see that sales taxes are, quite frankly, reliable and consistent taxes. This is one of the reasons that states love expanding the sales tax base because they're predictable. When a state budgets for a certain amount of sales tax, they can get it pretty accurately based on this information. You will notice all the way on the right side for Q2, that's our 17% drop in sales tax collections this year. Unlike income taxes, not very many sales taxes were deferred to Q3. So I'm a little worried about that number. And I think while there will be a recovery in Q3 and there will be more consumption in Q3 and Q4, we still have a hole in those state tax revenues. The other thing to consider is at some point in time, Wayfair was enacted, and almost every state has enacted economic nexus, capturing that activity. It's hard for me to see where that is in these sales tax collections in this graph. So maybe, David, that Wayfair helped that our Q2 losses only be 17%, not 20 or 25%. What do you think here? Could this be a lot worse?
Yeah, and by the way, and perhaps I'm the optimist of our group here between you and me, Mo. I think things. I think you're going to see an uptick in sales tax revenue in Q3 and Q4. But the money's lost is lost, right? That money that you're pointing out in Q2 is gone. That it's not coming back. The Wayfair question is very interesting because the thing that has saved the sales tax revenue, to the extent it's been saved, is online sales, right? I mean, and everybody on this call right now knows what I'm talking about. I'm looking out my window, and since this started, 3 Amazon trucks have gone by to deliver stuff at my neighbors, so the online sales, states are collecting it, right? Virginia is collecting sales tax right now from people delivering it, even though we're not going to the mall and we're not going to the stores as much. But the interesting thing about Wayfair is this. Wayfair is really important, and the states are happy they have it right now. But people like Amazon were already collecting sales tax in virtually every state before. So a lot of the big guys were already collecting it, a lot of the big retailers. And really what saved it is online shopping, more so than the Wayfair decision, although the Wayfair decision certainly will have picked up some of that lost revenue that they weren't collecting for Wayfair. So yes and no. Wayfair has a lot, it's played a big part, but the bigger part is just the fact that we're shopping online, and that Amazon, that's who the state shouldn't be thanking Wayfair, they should be thanking Amazon, because Amazon's delivering like free, and remitting millions, hundreds of millions of dollars of sales tax revenue.
And you mentioned Amazon. What's interesting about Amazon is they were collecting sales tax everywhere before the Wayfair case.
Right.
So maybe that was the bulk of the non-collection. I want to talk about elections in this last slide before we move over to the CARES Act and some of the state legislative developments there. I think whether or not there was a blue wave for President-elect Biden or not, that might be debatable. On the state side and looking at state government, so state governors and state legislatures, I can tell you there wasn't a blue wave and there wasn't a red wave either. And I'm going to talk about that very briefly because it's very interesting. And sometimes the policy or the politics dictates the policy in a lot of ways. So here are the changes that happened in terms of states from a political standpoint. Montana elected a Republican governor for the first time in 15 years. That gives the Republican Party a trifecta in Montana. They have both chambers in the legislature and the governor. New Hampshire, both chambers of the New Hampshire legislature went from Democrat to Republican. And this is something that happens in New Hampshire. They flip both chambers back and forth every once in a while. They reelected the Republican governor, so that gives the Republican Party a trifecta in New Hampshire. And we talk about trifectas because if one party controls the legislature and the governorship, maybe tax policy can be enacted more efficiently, maybe. What's interesting, though, about these elections, and we're going to conclude 2019, because in the 2019 include Virginia, where the Virginia legislature flipped both chambers to Democrat. So in this 2-year election cycle, 4 state chambers switched parties. That is actually a historically low amount. I don't think it's been that low for 50, 60, or 70 years. So I find that interesting. There really wasn't a whole lot of change on the state side, whether it's on the governorship or in the state legislatures. Whether that has a major impact on tax policy, I don't know or not, but it is certainly worth noting. So ballot measures. What else happened on November 3rd? We're going to go through a couple of these, David, and then I'm going to ask you about them. Arizona Proposition 208. This is a high earner income tax, 3.5% on salaries over $250,000. I think it was to be used for teacher salaries. California Proposition 15, a fundamental change to how business real property is assessed. By the way, Prop 208 passed. Prop 15 failed. I'm a little surprised by that, but Prop 15 did fail. Colorado Prop 116 was a 0.08% personal and corporate income tax rate reduction, and that passed. And then Illinois Amendment 1, which would have created graduated personal income tax in the state, probably would have raised a lot of revenue and also would have increased the corporate tax rate. Sports betting passed in a number of states too. Illinois Amendment 1 failed. David, surprises? Well, what do you think? Were states betting on these?
Yeah, well, I'll tell you what you can bet on. You can bet on marijuana taxes in the coming year because four states adopted marijuana, legalized marijuana. They did it for the tax reasons. You're going to see, I predicted a long time ago that every state will eventually legalize marijuana and tax it. I think we're heading in that direction. Tobacco taxes are kind of low-hanging fruit, and states will do that when they can. The surprising, I don't know. To me, Proposition 15 was not surprising because really it was a rollback of the limitations on Prop 13, and people in California to this day love Prop 13. So that didn't surprise me too much. The most interesting one in very blue Illinois, they rejected the graduated income tax. You're right, you can't get a state bluer than Illinois, and they said no to the graduated income tax. That surprised some people. But to me, the most interesting of all of these is Arizona, because when given a choice, most people will vote against higher income taxes, even on the very wealthy. And we've seen that in a lot of states over the years. And I think what happened in Arizona is proponents said, you know what we're going to do is we're going to take that money, market completely for education. And I think when states earmark initiatives, for something that the citizens think is a normative good, like education and teacher raises and things like that, much better chance of it passing, as opposed to just, hey, we're going to raise taxes and put it in the general fund. People are a little bit more wary of that. So to me, the Arizona one was interesting, mainly because of the, I shouldn't say tactics, but because of how they went about getting the higher income tax. Illinois, Colorado, and California still, to me, show that when people have a chance of voting higher taxes or lower taxes, they tend to go lower.
Yeah, that's interesting. And if you look at the sin taxes, you mentioned the marijuana, cigarettes, alcohol, every single one of those measures passed. So right. To the extent that helps with state tax revenues, maybe a small amount that can help fill some of the shortfalls. So with that, Mark, I'm going to ask you about the CARES Act and what does it mean for the states and what have you seen?
Thanks, Mo. I appreciate that. Hello, everyone. Thanks for joining us today. So what I'm going to mainly focus on is the CARES Act and the state's conformity. And I apologize now because this is going to get a little bit tax technical, just because it's sort of the nature of this. But I will, I'm going to try to keep it as simple as possible. But I think, the complexity of it is sort of the point that we want to get across. So before we get started, we do have a polling question. How do you think states will react to significant budget deficits? A, decouple from the CARES Act in its entirety. B, decouple from specific provisions of the CARES Act. C, suspend NOLs. And D, do nothing. States are slow to issue legislative guidance in a normal year. And when you pick your choice, you can make sure you hit the submit button. But I can tell you that in kind of following all of the state conformity to the CARES Act, it's likely that there will be changes before I am done speaking today. That is how frequently we see these changes. So I think that any of these answers are potentially correct. It's just a matter of, as Mo said, we have to wait and see. So with that, I'm going to go ahead and put up the results here. So majority say that they think that they're going to decouple from specific provisions of the CARES Act, and we've already seen some of that. 20% say do nothing, and that's, some states haven't done anything. We've already seen California suspend NOLs, and then, full decoupling from the CARES Act. Again, we have seen some of that already. So this is going to be sort of a moving target as we go forward. All right, so in talking about this, in any federal tax change, the first question is always a matter of conformity. And my discussion is going to focus mostly on corporations, but the concepts are the same for individual taxes as well. So anytime there's a federal change, you have to determine what the states are going to do. How do they conform to the Internal Revenue Code? Now, the vast majority of states, when you file a tax return, they'll start with either line 28 or line 30 of the federal return, the difference between those lines being NOLs, net operating losses, and special deductions like dividends received deduction. And that, again, that's related to corporations. And then the states will make modifications, adjustments for items that they do not conform with. And so there's sort of this difference between the mechanics of how a return works versus how the states or when the states actually conform to the Internal Revenue. So the first methodology is rolling conformity, which is essentially we're going to follow whatever Internal Revenue Code is in effect currently as of now, and of course states can decouple from specific provisions. And right now there's 22 states that are rolling conformity. You have your static or fixed conformity states that conform as of a specific date, and there's 15 of those states. And then you have specific conformity where the state ties to specific Internal Revenue Code section. Now again, IRC conformity doesn't mean that the states are going to follow all of the provisions, and generally they don't. They will decouple from certain things. Now, for purpose of this discussion and as we move through these, I'm going to focus on or use Alabama, Georgia, and Tennessee to kind of illustrate how this all kind of plays out. I spend a lot of time working in those states, And the states are different enough that you'll get to see some of the different potential treatment that we see. Now, before we jump into the specific provisions, note that Alabama and Tennessee are both rolling conformity states, although Tennessee has more of a tendency to decouple from specific provisions than Alabama does. Alabama is a line 30 state. Tennessee is a line 28 state. Now, Georgia is a static conformity state. So they conform to the Internal Revenue Code as of a specific date. However, they update it every year, generally in March. So as of right now, Georgia conforms to the Internal Revenue Code as of March 27th, 2020, which is the same day that the CARES Act passed. However, this is very important, is that they conform to the Internal Revenue Code as of March 27th for tax years beginning on or after January 1st of 2019. And when we talk a little later, you'll see why that's important. So one thing just to mention on individuals, the Tax Cuts and Jobs Act limited business losses and offset other income, and the CARES Act removes those excess business loss limitations for tax years 2018 through 2020. All right, so these are the provisions that the specific provisions we're going to talk about. There's one more we'll mention. And again, the way I'm going to do this is I'm going to walk through each provision, briefly explain what the federal provision is, and then talk about kind of what that means in Alabama, Georgia, and Tennessee. All right, so the first one are NOL. Now, prior to the CARES Act, there was no longer an NOL carryback allowed, and the usage of NOLs was limited to 80% of taxable income. Now, the CARES Act allows a 5-year carryback for losses incurred in 2018 through 2020, and you can fully offset taxable income. And that's the federal rule. Now, companies can either do that by filing an amended federal return or file Form 1139, which is a tentative claim for refund. And this is important in a minute when we talk about that means for. Now, just to sort of, not keep anyone in suspense from a conformity perspective, almost every state does not allow this NOL carryback. There's only 4 or 5 states that are actually going to allow you to carry back this NOL pursuant to the CARES Act. So then why do we really care? Well, we care because anytime you have a federal change or file a federal amended return, you're required to file an amended state return. So if your federal return is amended to report an NOL carryback, then you certainly need to amend your state returns that you've been filing. If you file a Form 1139, the question becomes, is that really an amended return? And there's only a handful of states that specifically address it. Now, even if it's not an amended return, if you're carrying back an NOL to a year in a state that is a line 30 state, it's very possible, because federal taxable income has been changed on line 29 of the federal return, that your federal taxable income as your starting point in that state has actually been changed, and therefore you may potentially have to amend that return under the state rules. A state like Tennessee, maybe you wouldn't, because it's a line 28 state, so if you carry back an NOL, it doesn't impact federal taxable income as reported to Tennessee. So a question here should be, well, if I can't carry back the NOL for state purposes and it has zero impact on my state return, why do I need to do anything? Why should I even bother? Well, the reason is that it's the statute of limitation. So if you don't file an amended state return when you're required, even if it's a year that's already closed under the regular statute of limitation, not filing that return could open up the statute indefinitely in that state. So again, you might ask, well, why does that matter? I can't, if the federal changes in NOL, it doesn't impact the state anyway. Well, there are states out there that will allow themselves to adjust other items on the return that have nothing to do with that net operating loss carryback. Now, Alabama, Georgia, and Tennessee are not any of those states that do that, but there are states out there. So you don't amend a return, the statute is technically open, state could come back and assess tax for unrelated items. The other side of the equation is that it works both ways. So if the year is open, there is an opportunity for a taxpayer to go back and look for offsets or refund claims for those years, because technically the year is still under statute. One last point on the NOLs is that if you're filing an amended federal consolidated return, you may have to amend separate state returns, even for entities that did not have losses, because filing that amended return is effectively an amended return for each entity that's included in that return. So there's a lot of issues here. Doesn't necessarily impact your state tax as it relates to the NOL, but there could be some other implications. All right, so let's talk about 163J. So under the Tax Cuts and Jobs Act, 163J limits interest expense deductibility to 30% of adjusted taxable income. And any disallowed interest can be carried forward indefinitely and be utilized in a later year. Now, under the CARES Act, interest expense limitation was increased from 30% to 50% of adjusted taxable income for tax years 2019 to 2020. So basically, it allows an additional amount of interest deductibility. So your state questions are, in first, general conformity to 163J. And then if a state conforms to 163J, does it incorporate this increased limitation under the CARES Act? So Alabama, rolling conformity state, it's done nothing to decouple from 163J or the CARES Act. So the assumption is that they would follow this increased limitation in Alabama. Georgia, while its conformity date incorporates the CARES Act, it does not conform to 163J at all. So you're allowed to fully deduct interest in Georgia in the year that the interest occurred. And Tennessee, just to be different, conformed to 163J for 2018 and 2019 only, and not for other years. So you do sort of have this potential increased limitation for 19, which is covered by the CARES Act change. And in Tennessee, you can carry forward those disallowed losses, and they can be used in the future to the extent that a federal carry forward is used in the future. Now, remember, though, in states like Georgia, where you're fully deducting your interest expense currently, in a later year when you're allowed to deduct the carry forward for federal purposes, you have to add it back because you already deducted that interest. So one last thing on 163J, you have sort of this set of states in the middle that are fixed conformity states that conform to it prior to the CARES Act went into place. So you would still have that 30% limitation, not the higher 50% limitation in those states. So you would have an add back of that 20% differential. So qualified improvement property, this was a category when it was originally put in place with 39-year property, and it allowed a bonus depreciation option, and this is prior to the Tax Cuts and Jobs Act. Under the Tax Cuts and Jobs Act, some non-residential property was added to the category, and bonus was removed as an election, and this was what commonly referred to as the retail glitch. But the CARES Act corrects it, changes it to 15-year property, and once again allows a bonus election. Also, it can retroactively apply property placed in service in 2018. Now, I think it's important to note here that there are states, many states don't allow bonus depreciation anyway, so that doesn't really do anything. So the benefit may just be in those states shorter depreciation period. Now, Alabama and Tennessee conform to the useful life change because they're rolling conformity states, but Tennessee does not allow bonus depreciation anyway, Alabama does. And now Georgia does not allow bonus either, and they conform to the useful life change because of their conformity date doesn't incorporate the CARES Act. But what I mentioned before is that the effective date of Georgia's conformity is only for tax years beginning on or after January 1st of 2019. So they would not allow a change in useful life for the 2018 tax year. So again, just sort of a little bit of a difference there in Georgia. So this is the last thing I'm going to talk about. So So the CARES Act allows certain employers to take a credit based on a portion of the FICA tax that they pay. But under Internal Revenue Code Section 280C, you can't take a deduction for an expense for which you're claiming a credit. So there's a reduction in deductible wage expense if you're claiming that credit. So the question in the states is that, well, if you're not getting that credit at the state level, it seems like you should be able to fully deduct that wage expense. States are sort of all over the place when it comes to this, and not all states would allow that increased deduction. Alabama, Georgia, and Tennessee all do specifically allow a deduction when you're for something that's not deductible for federal, when you're taking a federal credit. So I think it's just important to make sure that you look at the states that fully take that deduction if you can, but note that some states will not allow. So with that, we've got another polling question here. So what do you think is the most complex issue for this filing season? A, conformity to the CARES Act. B, understanding last-minute guidance from state. C, filing returns including wet signature requirements, and all of the above. So I'll give you a few seconds here to answer. And again, don't forget to press the submit button. I mean, for me, I think that B is always the issue. It's last-minute guidance, and we've had situations where we filed returns for clients, and then the guidance changes after the fact, that you have to go back and amend. And while it's not a huge deal, it just gets a little messy, and it's not the easiest thing to digest. So with that, I'm going to go ahead and roll this over and see what you had to say. Yep, not surprising. 67% say all of the above. And I'm not surprised about the wet signature requirements. I mean, I don't think that's really been a problem. I think most of the states have been very forgiving as far as how returns are submitted and how signatures are done. And yeah, B, last minute guidance from the state. That would have been what I had picked up. And with that, I am going to kick it back over to Mo.
Thank you, Mark. That's a somewhat complex landscape. I know talking to our compliance folks here, this last busy season was tough, and there's a lot of guidance that we still don't have yet from the CARES Act. The states are going to continue to respond to this in 2021, and to some extent, we don't know what else is coming down the pipeline. If there's going to be, I don't want to call it CARES 2.0, but there's certainly more legislative packages on the federal level that could come through and just make this even more complex for us. So we want to talk about Wayfair very briefly. Yes, it's been 2.5 years from the decision, but when we look at our client base and we look at what's happening in e-commerce and what businesses have been doing and how they're responding to the Wayfair decision, we're pretty certain that somewhere around 35 to 40% of middle market businesses have not yet responded to the Wayfair decision. So I want to talk about why we care about that. There's one other thing I want to mention, and I just find this interesting. Two of the justices that were on the court that delivered the majority for the Wayfair decision are no longer on the court. Justice Kennedy, who wrote the decision, and Justice Ginsburg, who recently passed away. I think that's noteworthy in that we don't know what future Wayfair challenges are going to look like. We don't have enough time to talk about it today, but I just want to put that thought in your minds. The first thing we're going to do, though, is a polling question. Has your business considered the impact of Wayfair on your state tax nexus profile? So yes, we've reviewed economic nexus provisions and are actively following developments. Yes, but we're not really following developments, so maybe you looked once at some point after the decision or in 2019. C, Wayfair does not affect our business. There are very few businesses I have found that are completely insulated from the Wayfair decision. But there are a few that it's much more minimal. Or D, we would like to, but we're not sure where to start. I also want you to notice that the way we ask this question, we say state tax nexus profile. We do not say sales tax nexus profile. And that's because Wayfair doesn't just impact sales tax. It also impacts income taxes. And it could be a significant impact on income taxes too. So we're going to roll forward. So hit submit. If you haven't, this is our last polling question of the day. So you want to make sure you get that in. And yeah, so 41%, I think that's a great number, have at least looked at this and maybe following developments. 14% have at least looked at this once. I think that's very important. 30%, I think that's a high number, but 30% does not affect your business. And 13%, you would like to, but you're not sure where to start. That's completely fair. Absolutely. This happened so quickly after the decision happened that a lot of businesses were caught off guard. I know a lot of businesses took this wait and see approach because they weren't sure what the future was going to hold, and then all of a sudden it's a year later, it's 2 years later. So I want to show you the map, and this is why it's so important. See all these pink states? That's every state that has a Wayfair provision, an economic nexus provision for sales tax purposes. So at this point, that's 44 out of 46 states that have a state sales tax. Only 2 states do not. Florida and Missouri, every year we say those 2 states are going to go next year. They haven't yet, but every other state has. I also want to point out Alaska, which has no state sales tax, but they do have something like 106, 107 local sales taxes, and this is very important. Many of those are adopting Wayfair provisions on their own. So if you're a manufacturer and you sell a lot, or if you're selling products to businesses in Alaska, you may have a Wayfair obligation, a sales tax obligation there too. The same thing goes with states with home rule jurisdictions. So Colorado, which is notorious for being a difficult sales tax state, a lot of those home rule jurisdictions didn't have a Wayfair provision. Now the state municipal league, they've gotten together, they've formed some uniform law provisions, and many of those home rule jurisdictions are adopting Wayfair. So when you sell into Colorado, whether it's services or tangible personal property, you may have to collect the state rate and some of these local home rule rates, which you might not have had to have done before. I want to focus a little bit on the next 2 slides, and this is why it's important. To some extent, Wayfair came down June 21st, 2018. We're quickly approaching 3 years from that decision. And there are several states that their Wayfair provisions became effective on June 21st. So you're looking at 3 years. And then if you look to the end of 2021, there are going to be a lot of states that have had a provision for a 3-year period. And I think we're going to see an increase in audits specifically for Wayfair. We're actually already seeing Wayfair audits occur. So several avenues for the states to identify noncompliance. Here's the thing about Wayfair audits is that they're very, very easy to identify businesses that should be collecting sales tax that aren't. I've talked to a number of businesses that are concerned about the competitiveness in their industry or in their field. If they start charging sales tax, they know the competitor isn't charging sales tax. So a number of those businesses are now turning in their competitors. This is very active, and unlike the federal side, there's no, you don't get a finder's fee or anything like that in most of the states. Businesses aren't happy that their competitors are not charging sales tax. Also, departments of revenue, they have publicly available data. Your 10Ks, your SEC reports, your annual reports are available. And then also purchasing data, and we can talk about that. Data analytics is frankly, it's everywhere and it's cheap. I use this example of Indiana. I've used it for a couple years actually. For a few $1,000s, they identified over 6,000 companies that are probably going to be subject to their Wayfair provision. And in fact, they sent notices to a large amount of those companies. And that's based on credit card analytics. So a number of states are using analytics. Vermont, for example, I mean, this is as low tech as you get. Putting something in the cart and seeing if there's sales tax attached to it in the online shopping cart. And then Iowa, here we go back to this competitive issue. I spoke to somebody who was chasing down these leads, and they've been doing it for months because businesses want to be competitive. And to some extent, it feels like you have a competitive disadvantage. I don't know if sales tax is as competitive as it was maybe 10 years ago when everything you bought online, there was no sales tax, but it's a very real dynamic. The point is there's no hiding from Wayfair enforcement. That, coupled with the state budget discussion that we just had, maybe will lead to an increase in audits, especially for this low-hanging fruit, which is these Wayfair audits. So non-sales and use tax, I want to mention this very quickly. Income taxes. Yes, Wayfair has an impact on income taxes. Hawaii adopted the same standard they use for sales taxes. They adopted for the corporate net income taxes. That's 100,000 or 200 transactions. Texas franchise tax, 500,000. Massachusetts, 500,000. Pennsylvania, 500,000. Oregon had a cap this year, not Wayfair related, but it's still an economic nexus standard. Philadelphia for their local tax, $100,000 Wayfair standard. So the point is, this is everywhere. 2020 was not a very active year. So we saw actually I think there was one legislative development on the Wayfair side in 2020. A lot of these income tax provisions and sales tax provisions were from 2019. Some of them were effective in 2020. 2020 legislatures were busy trying to figure out the pandemic. So we're going to see this activity pick up in 2021. And we know we have these factor present states already, 7 or 8 of them before Wayfair. Now we have a bunch of other states using these Wayfair standards. I wouldn't be surprised if this is a really easy way for states to target additional revenues, just increasing these nexus standards to more economic, more market activity type of standard. So with that, looking ahead to 2021, I hope the takeaway here is that it's an uncertain climate. I think when David and I were preparing for this webcast, we were a little bit more positive because, well, it sounded like we were getting reports that revenue collections were better than they were in March and April and May, and to some extent that was true. But then now we have an increase in cases, we have possibly more stay-at-home orders, more virus, more hospitalizations, and we start to get a little pessimistic again. So have a plan, be ready to act, understand or have a way to track what's happening at the state and local level, because you're going to see tax increases in 2021. You're going to see that base broadening probably in the sales tax, maybe not increases in rates, but certainly more things subject to tax, digital goods, maybe more services as well. And expect active 2021 sessions. Where 2020 wasn't very active, I think 2021 is going to be busy. We're going to be writing a lot about it as well. So with that, Allison, I would like to turn it over to you and for the cleanup.
Terrific. Thank you so much, Mo, and thank you to David and Mark as well. Terrific presentation. We do want to remind you that you can return to the virtual environment and experience all of the event has to offer for the remaining 2 days. We encourage you to visit the Ask the Experts locations for our scheduled chats for the next 2 days. And don't forget about the scavenger hunt contest and leaderboard in the game room. We also encourage you to visit the networking lounge and network with all the other participants from RSM's Tax Summit. A couple of reminders to our participants before we conclude. Please take a moment to participate in the attendee survey by following the link in the resources list to the right of your screen. As Mo mentioned at the start of our call, we've provided a number of resources to you in the resources list. Please take a moment to stop and download those and access those resources before we conclude today's presentation. If you have met all CPE criteria, you may download a copy of your certificate by visiting the Certification Center and clicking the download icon. You may need to scroll down within the window of the certification widget to access that download icon. Be sure to save a copy to your computer here in the next few minutes before we conclude our event. Smartphone users can download their certificate from any computer at a later date using today's webcast link. And thank you once again to David, Mo, and Mark for joining us today, and to all of our participants for joining us. We look forward to you joining us for the remainder of RSM's Tax Summit. Thank you.